Delighted to see this turnout. I think to see a hall full probably indicates that investors के अच्छे दिन आने वाले हैं. You know, a couple of things. One thing which Udayan touched in his address was a small discussion that we were having on the sidelines about investors' participation in the market. And I just thought I'll probably elaborate a little further on that. You know, what we do as a country or as people in this country, I think we are generally very value conscious, very price conscious. A lot of FMCG companies in India say this is a very price sensitive market. We have to keep our prices, let's say, price points really worthwhile for people to buy. But when it comes to investment, you know, we don't always make very rational choices. When in our buying behavior, when we are buying goods, when we are buying services, we are probably very rational. Why I'm saying that is very simple. If I really look at the data of FIs buying into India, and I'm sure all of you probably follow that, FIs would typically in a good year buy about $20 billion worth of stocks in India. Now, as opposed to that, we as investors in this country ship out close to $60 billion outside buying gold. So all these years, FIs have been buying Indian stocks. Their holdings from 1991 when they started, which was 0%, has gone to 24% because they have confidence in this market. But to the contrary, we have been reducing our holding as investors. And if you really look at the long-term returns of these two asset classes, I think the picture is very clear. The BSE Sensex, you would know, probably started in 1979. It was 100 then. It's at 25,000 now. That's a 250 times gain. Over the same time, if you had your money into bank deposits, earning about 8% per annum, your money will go up 16 times. Now, 250 times versus 16 times, you don't need too much of a maths to figure out which asset class makes more money. People here love gold. Gold prices have probably gone up 40 times over the same period of time. And instead of buying a broad market alone, if you bought a fund managed by any of the mutual funds, they typically end up outperforming the market anywhere between 3 to 5%. So instead of 250 times, your money would have been theoretically 500 times up over the last 35 years. Now, there's serious amount of money which is being made in the market. It is just that probably we as investors are not participating. If I look back at data from 1991 till date, there have been only 2 years in which FIs have sold net equities in India. Every single year they have bought. One of those years was 2008, global financial crisis, you can understand. And probably the other one was marginal outflow in 2000. Whereas if I look at our own investors' data, every single one of last 6 years, investors have actually been selling equities. So when the market came down, none of us went ahead and bought equities. And of course, it's good to see that some interest is coming back. But more often than not, this interest only comes back when the market starts rising. Now again, when market starts rising, one of the questions that people would ask is, am I too late? And Udayan tried to answer that question. And I'll just say very simply, market has gone up probably about 20% from the bottom, right? And as such, the prices have gone up a little bit, indices have gone up, but the valuations have not gone up. We are still trading at about 16 times 1 year forward, which is pretty much in line with what our averages have been over the last, let's say, 10, 15, 20 years. And if you really look at where the market tops out, where it peaks out, that typically tends to happen between 25 to 30 times valuation. So indeed, there is still far from being, let's say, in a danger zone. Markets are probably at the beginning of a positive cycle in the equities. This is probably one of the better times to be looking at markets because we have got now a strong government, a clear path, a stability of policy regime, a clear, for the first time, you have got a government which wins on a developmental agenda. So in that sense, I think the policy priorities seem clear. And if those policies get into action, and we should give some time for that to happen, then of course you could see a multi-year cycle. Currently, again, one of the things that you should keep in mind is, if you look at corporate India earnings, there are two things that stand out. From an operating margin perspective, from the margins that the companies are making on sales, we are probably at one of the third lowest point in the last 20 years. So the margins of companies are really crunched at this point of time. And again, sales growth-wise, we are still at a low point. As the markets grow, as the economy expands, you can have multiple effect. You can have sales growth coming back, as well as you could have some margin expansion. Now, if that happens, then the earnings actually don't grow at 10, 15%. They could actually rise at 30% CAGR plus. So indeed, the potential for growth is reasonably significant from here. But let's take a medium-term view of the market. Since the time this government took charge on 16th of May, market was at 7,200 Nifty on that day. Today we are at 7,500. So on Nifty, we have probably only gone up by about 6-7%, 300 points. Right? Whereas on the number of stocks, the rise has been a lot sharper. Let us stay conscious about the quality, as well as let us take slightly medium-term view of the market. Let's not expect that stocks will keep doubling every 3 months or 4 months. We are in a positive market, but we are in a market where we should be putting our money to work over a period of time, expecting reasonable return. If you take a medium-term perspective, I think there's nothing to beat the capital markets or beat the equity markets. We as investors, what we have been doing over the last, let's say, few years is we have been shifting away from capital market or financial assets and putting more of our money into what we call physical assets like real estate or gold, to a point that our financial assets as a proportion of savings of investors has come down from 50%, which is what we used to be a few years back, to as low as 30%. So out of every 100 rupees that we are saving, we are putting 70 rupees either in buying gold or into real estate. Now that kind of a situation in India used to happen sometime in 1970s. And from there on, all of us would agree that economy has come a long way, markets have come a long way. But I think we as investors have gone a little more retrograde in terms of our allocations, where we have shifted away our savings from financial market and gone a lot more into saying that I would trust real estate, I would trust gold. It's about time that we start looking beyond that. Very opportune time, if I would say, both from a long-term return perspective of these asset classes, as well as from here on, the promise that these asset classes have. Have a balance in the portfolio, not to say that everything should go in stock market, certainly not. There could be some volatility there. So do a balance, do some amount of money into equities, have some money into the fixed income allocations. If you have full time available with you, if you are able to track the markets on a minute by minute or a very regular basis, then try to play it by yourself. Otherwise, do trust mutual funds, because in general, in fact, I was at one of the conferences which SEBI chairman addressed just about a couple of days back, and it is the data which came from SEBI, that 85% of the mutual funds actually outperformed the equity market over the last 3 to 5 years. And in general, most of them end up outperforming about 3 to 5%. Now that actually, as I told you earlier, that means that if the market goes up, let's say 6 times or 7 times over a period of 10 or 12 years, in a mutual fund, your money could grow probably at about 8 to 10 times. Now, there's a serious potential to make money there. Do consider some of the capital market or the, let's say, financial asset products as opposed to the physical assets product. So that's broadly what I wanted to highlight here. Now coming down to the budget, we are looking forward to budget, first maiden budget of the government, which comes on 10th of July. Indeed, this government has been in office only for about 45 days or thereabout before this budget gets presented. And expectations from the government are fairly high, both from industry, because it was on a development plank, from individual or from normal public, because this government has promised Achhe Din, as well as from investors, because they are looking at finally the markets picking up. So it's a tough balancing act for the government. In terms of the expectations, I would imagine some of our other speakers will cover them as well, but just from the capital market perspective, I would say that this increased allocation that we have seen into physical assets over the last so many years requires indeed some thinking from government to provide incentives for investors to come back to capital markets. So if they can provide some incentives to investors separately for investing either into equity market through IPOs or through mutual funds, I think that can probably help investors as well as markets a little bit. Otherwise, again, let's understand that budget is an annual event, whereas the government's path is a longer term one. So let's look at the broad initiatives that they have taken. Let's look at the broad path that they have taken, the announcement that they have made so far, the ministries that they have allocated. So far, I think most of the announcements they have made, or so far most of the, let's say, steps that they've taken are fairly positive. Whether it is merging of coal ministry and power ministry to ensure that power plants are not stuck because of coal linkages not being available, or whether it is fast-tracking the environment clearances, which used to take about 6 months typically till 2010, but between 2010 to 2013, we have seen environment clearances for project taking as much as 2 to 3 years on an average. So really what you had was a situation where a lot of money was stuck in projects and just not getting cleared. And this government has started taking steps on the right direction there and has announced that they would probably do a internet-based or e-clearances or auto-clearances on some of these things. Again, there have been some tough decisions on, let's say, rail fare hike, tough decisions on diesel subsidy removal or reduction. And there has been some amount of rollback also, which indicates probably tough decisions are indeed tough to carry. But nonetheless, I think overall, the broad specs or broad moves seem to be fairly market friendly. And we could probably expect budget to have some further leg up in the similar direction. So in that sense, I think the expectation from budget alone should not be too much in terms of announcement, but it is more as an intent document coming from the government who has just taken charge, being the first policy document from them. That is more of a signaling device as opposed to saying that have 10 things been met in the budget. So in that sense, I think this is important to watch, but it's not a make or break kind of a thing. So broadly, my message would be, do look at capital market allocations. I think we are missing out a significant part of the opportunity that this country provides. Do start taking the financial markets a lot more seriously, and indeed do reduce, if you could, your allocation to physical assets. So that's broadly what I would say for the moment. Thank you all.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.